Buy now, sell now. We bring you all the Pathshala segment. And Kunal is here, as always, to talk to us and give us more insights. Kunal, today you're talking about something that is very inciting in terms of how do you look at a dip coming in? What can you be... how do you use the moving averages to identify long-term opportunities during this correction or a crash that comes in?
Thank you so much, Vinny, for that. Good morning to all of you. So today, the topic of the Pathshala is that how do you try and capture a correction, a small correction, a mid-sized correction, and a big correction. By big correction, we can probably term it as a panic. So I've used three simple moving averages and extrapolated this moving average on the monthly charts for the Nifty. And to give you a very simple indication over here, what I've used are three important averages. One is the 24 EMA, which is the 24, which is the 2-year exponential moving average. The second which I've used is a 60 EMA, which indicates 5 years of exponential moving average. And the third which I've used is 120 EMA, which is almost 10 years of exponential moving averages. So the first one which you can see over here on the charts, this is the simple moving average. This is a 24 SMA. Now what this, why is this important? Because as you can see that whenever the index gets into a corrective phase, the correction tends to end closer to this 24 exponential moving average on the monthly charts. So these are the small minor corrections where the indices tends to end the correction closer to these moving averages. Now what happens in a second sized correction, a slightly mid-sized correction? So say for example in 2011-12, look at this phase over here. This was the phase where this mid-sized moving average acted as strong support, and anyone who's managed to buy the index at those levels actually managed to buy this at the the crux of the market correction for itself. Look at this in 2015-16 as well. When the mid-cap route was actually going on, this was the time when the index managed to take support at this crucial moving average. Now the third and the most important point, the ones where I think the market gets into a capitulation phase, are those extreme levels of panics. And this is what, for example, this is 2020. Now look at how the index took support, multi-month support at this crucial moving average over here. This was in 2008-9. And look at the confluence of the index closer to this key moving average. The panic tends to settle closer to this moving average and value emerges for the indices at these levels. So this is a very simple way of trying to understand that whether you are buying into a correction, what level is the most important level to watch out for, and which are the levels to watch out for when you're buying into a big panic phase. For example, the recent one where we are currently trading right now, we have just completed a corrective phase of on the indices. So we have neared into the 24 exponential moving average on the Nifty, and that is why short-term traders or short-term market participants are expecting that if this is a corrective phase, then the market should try and bottom out closer to these levels.
Okay. Kunal, so I just want to ask one thing. I was going to come to the point where you pointed about the recent chart coming in. So now, if it goes below those levels, the 24 average which you did mention, that means that is a time when the correction will start and it could go further, and that's the time to buy?
So from a short-term play, this is a good time to buy. Assuming if we break this particular moving average, then which is the next level which we go back, we look at this particular level being reached on the index. This as of now is at 13,700. Of course, that's an extreme for the indices. But in case if this support breaks for the index, say going forward, then we look at the second most important moving average as acting as strong support.